Okay, let's talk coding flips versus rentals. Okay, so flip properties are treated as inventory by the IRS. So it's just essentially like a product, right? Or it's treated as inventory. So it goes on the balance sheet, and then it is fixed up, and everything that all the expenses associated with the flip property go on the balance sheet and inventory asset accounts. Which we'll in another video we'll kind of see how that breaks out within our custom real estate investing chart of accounts. Not in this video though, because we're just kind of explaining the difference, right? So flips are inventory until they are sold, and then everything's transferred to cost of goods sold. So it's the income, minus all of the COGS, and then you have your net income at the bottom or your profit. Okay, and flip properties. Some of the expenses and things associated with the flip property go on the balance sheet, while others go on the income statement. Okay, during the life of the rental property. Okay, so if selling a rental property is usually not in the business plan, honestly, for real estate investors. Or at least for myself, when I buy a rental property, I plan to hold that rental property for a very long time. Tenants pay off the mortgage, get cash flow in the meantime, get tax benefits in the meantime. There's a whole lot of benefits to holding rental properties that actually cash flow, right? And so it's a whole different business model. So the flipping business model is we're going to purchase the property, we're going to fix, significantly under market value, preferably fix the property up, and then we're going to sell it to another investor or a person looking to purchase the home and actually live in the home. And then rental properties, as we know, the buy and hold strategy, we're going to purchase the property again, hopefully under market value, fix that property up if necessary, and then rent it out to a tenant or multiple tenants. And they are going to pay us rent on a monthly basis. We're going to use that rent to pay all the associated expenses of the property, and we're going to keep whatever is left over, which is the cash flow, right? And we're also going to save for future expenses like CapEx, capital expenditures, vacancy turnover, repairs, future maintenance and repairs, things like that. So there's a reserve component to the rentals as well. Okay, but as far as the difference, coding flips and rentals, they are totally different. The liability accounts are pretty much the same. The escrow accounts are pretty much the same, but the asset accounts are different. The balance sheet accounts are different. The income accounts are different. So for flips, everything goes into inventory asset accounts, purchase, renovations, holding costs, buying costs, selling costs, everything. And then after the sell, everything is transferred via an adjusting journal entry over to the income statement. And then, like I said before, then we have our income, and we have all of our cost of goods sold. And then at the bottom, we have our net income, which is our profit for the flip. Okay. Rental properties, the building, what the purchase price of the property gets broken out between the building and the land. Closing costs gets capitalized, or at least a portion of the closing costs, while other portions are not able to be capitalized, and depending on what your tax strategy is and that sort of thing. So there's publications we need to reference for rental properties, right? Publication 551 is a big one, and there are others as well that have been showcased or will be showcased in this course. So not going to get into those, the nitty-gritty details of those for this video. But just know rental properties are honestly a little more complex than flip properties. Okay, you have to reference publications, capitalize things, deduct things, and do everything appropriately. There's a tax basis for the rental property, and then there's different capital expenditure accounts that have different useful lives, and then you have to factor in bonus depreciation. There's a if we're going to take bonus depreciation, or if the current tax law even allows for that. So for a client or for yourself, if you have rental properties, definitely consult a tax professional and a tax strategist for your real estate dealings. Okay. Same for a flipper as well, but most real estate investors flip and have rental properties. There's a combination. So that's one more thing to tell you for rental properties. The rental income, it just goes to income accounts. You know, all expenses that are not capitalized go on the income statement, so expense accounts. And that's pretty much all I have to tell you for this video. I just wanted to kind of give you an intro to, flips are different from rentals. They are coded differently, and a little introduction on how they're coded differently.